Welcome to our weekly High Rock video. If you are watching for the first time and are interested in learning more about High Rock, please check out our website at highrockcapital.ca. I'm Scott Tomlinson, and joining me is my partner and colleague and the founder of High Rock, Paul Tepsich. Normally we talk about our three models and any important updates with them and what we see happening in financial markets, the global economy, and the world of wealth management. So Paul, a bit of a return to volatility today. It appears that our expectations for a more volatile 2018 is playing out. We've got the U.S. Federal Reserve tightening. We've got the prospect of other central banks thinking about turning off the liquidity tap. And certainly there's a bunch of uncertainty around the global trade situation. And that's, I think, at this juncture, getting investors to start to take off a little bit of their risk appetites, right? Paul, you with me?
Sorry, yeah, and some of the investors I've been talking to directly have been pulling back some risk, allocating or pulling back on allocations to various managers. Some folks want to see what plays out here with these tariffs and the implementation of them and how far they go. And some even want to, I was talking to a guy last week, is a little bit concerned about how Ontario might play out politically, as well as with these tariffs. So for sure, it's provided an element of paring back risk for sure.
Yeah, and this isn't something that comes to a big surprise to us, really, right? I mean, we've been talking about this for quite some time, and we're starting to see more and more people talk about it. After I was on BNN last week, the same day, a more famous economist, David Rosenberg, came out and said the S&P has topped and a recession is coming in 12 months. So I guess that's other people falling in line with us, right?
Maybe Rosenberg's reading you.
I get that somehow. Anyway, so today U.S. stocks were lower. The Dow was down by 1.25%. Pretty much the same for the S&P 500. You can see here the S&P 500, pretty good downward move through the course of today. That lower line coming up from the lower left to the upper right is the 200-day moving average. You can see where it has been somewhat of support previously. Probably over the next few days or at least a week, we'll see some testing of that level again, just to get a sense of whether or not there's still some buying support left in the market. And that should be pretty important from a technical perspective. Certainly the TSX, which had been having a pretty decent run. Paul, you might want to chime in here, but pretty off day today, right?
Yeah, along with everything else. I mean, oil's down a little bit. Gold continues to come under pressure. Yeah, today was a pretty red day for most everything. So
specifically, and I failed to mention the Nasdaq, but it was down actually over 2.25%. So it was the real big down market today.
In the U.S., yeah, that's true. Very good point. These FANG stocks kind of gave up the ghost a bit.
Yeah. Same thing happening globally in Europe as well as Japan. So, and even Japan's probably been holding up reasonably well. Still no certainty from what the Bank of Japan is intending to do as far as reducing liquidity there. But sorry.
Nope.
Okay. And then, of course, next is our continuing watch of the yield curve in the U.S. Pretty close to the lows since back in 2013. As we say each week, we think that flattening of the yield curve has the potential to lead to recession. There are some arguments that with the fact that there is also so much liquidity in other parts of the world that this won't be as impactful. But Paul, any comments on that?
Well, people may say it's different this time, but I don't think it is. And we don't have the graph up right now, but we've shown it so many times before, is overlaying this U.S. 230s curve with U.S. recessions. And, this thing continues to flatten. It's telling us something, and Rosenberg may very well be right. A year from now, we could be in for a U.S./Canadian recession.
Yeah. And I think that falls into the theme that we've been talking about, and certainly what I talked about last week, and that being that we're pretty much at the tail end of the economic cycle. We're 10 years into this one, and it's time is just basically running out. In Canada, even flatter yield curve, but not right at the lows. It's up ever so slightly over the course of the last week or so. Paul, anything we're doing with our fixed income? I noticed some buying of U.S. 2-year Treasuries last week.
Yeah, we held it. We bought a U.S. Treasury 2-year Treasury bond, sort of in placement of cash back in January of this year, and we rolled that forward to a new U.S. Treasury bond, so just really 6 months forward. And we actually took out our U.S. dollar overnight interest deposit that we held on our U.S. cash and put it into this 2-year bond, a U.S. 2-year bond. So it's paying us around 2.55% right now. I see it as pretty much cash. The price volatility of that 2-year bond is really not very high. And I've shown this chart before, but all of a sudden now, around 250 on a U.S. Treasury note is kind of a real yield. They got down substantially, and I can tell you 1 second, Scott, if you bear with me. The low in that U.S. Treasury yield on a yield basis was 50 basis points back 2 years ago, June 24th, 2016, almost 2 years ago to the day. So that was at 50 basis points. You're picking up now 253. That's all of a sudden kind of a decent yield. When you look at global equity markets around the world and what they're up year to date, I mean, the Dow and the S&P are flirting with up zero, and the Nasdaq's up 9% year to date. The TSX is flat year to date. And I'll just give you a quick snapshot of European exchanges or in euro currency are all red. They're anywhere from down 0.5% to down 8.7%, which shockingly is the Swiss market, not the Italian market. So, when you start looking at those equity returns, basically at flat to -5, let's call it, on average. Now, if you can pick up 2.5% across the year in a U.S. Treasury bond, the safest security in the world, it's not bad. Not bad at all.
Compare that to what a 2-year Canada bond right now, for example, right? I mean,
well, that's at 1.75, basically 177.
Yeah. So
the interest rate differentials are shocking because the U.S. currency has been getting, lately over the past 2 months, 3 months, it's been going higher, U.S. currency, on a weighted average basket basis to a pile of other currencies, a trade-weighted basket. But, the Fed was hiking rates, and probably still is, hiking rates more and faster than any other central bank in the developed world, for sure. Yet the currency was getting hammered. And now we've got these wide, what we call interest rate differentials, i.e. the interest rates in U.S. bonds are much higher than other government bonds around the world, and yet the U.S. dollar was getting hit. It made no sense. As interest rates go up in a country, government yields go up, typically it attracts more capital into the currency, but that has not necessarily been the case in the U.S. dollar.
So not only are we getting better yields by 0.75% in with our U.S. Cash, we're also have seen the Canadian dollar fall by about 5 US cents So somewhat of almost a 6% increase in the U.S. dollar. So combining those two situations in a pretty safe or what we'll call sort of risk off situation, that's not bad for our portfolios, for our clients.
Yeah.
All right. Well, that's it for this week. We're going to be back again next week, but thanks for taking the time to tune in. In fact, we probably won't be back next week now that I look at it, because it is Canada Day weekend. So we'll probably not be back for a couple of weeks unless there's a need for some emergency discussions. But again, as usual, please feel free to send in feedback. It's great to get some feedback from you folks, so we know what you want to hear from us on a week-to-week basis. But until next time, we hope you have a great rest of the week, the following week, and have a great, happy Canada Day.